Is a curious thing. Make one man weep, make another man sing. Change your heart to a little white dove. More than a feeling, that's the power of love. Tougher than diamonds, rich like cream. Stronger and harder than a bad girl's dream. Make a bad one good, make a wrong one right. Power of love will keep you home at night. Don't need money, don't take fame. Don't need no credit card to ride this train. It's strong and it's sudden and it's cruel sometimes, but it might just save your life. That's the power of love. That's the power of love. First time you feel it, it might make you sad. Next time you feel it, it might make you mad. You'll be glad, baby, when you're found. That's the power that makes the world go round. And it don't take money, don't take fame. Don't need no credit card to ride this train. It's strong and it's sudden, it can be cruel sometimes, but it might just save your life. They say that all in love is fair, yeah, but you don't care. But you know what to do when it gets hard. And with a little help from above, you feel the power of love. Feel the power You got too far this time, but I'm dancing on the Valentine. I tell you, somebody's fooling around with my chances on the danger line. I'll cross that bridge when I find it. Another day to make my stand. Oh, high time is no time for deciding if I should find a helping hand. Oh, why don't you use it? Try not to bruise it. Buy time, don't lose it. Why don't you use it? Try not to bruise it. Buy time, don't lose it. To reflex is a lonely child who's waiting by the pole. To reflex is in charge of finding treasure in the dark. And watching over lucky clover isn't that bizarre? Every little thing the reflex does leaves you answered with a question mark. I'm on a ride and I wanna get off, but they won't slow down the roundabout. Sobering worry, TV said, don't wanna be around when this gets out. So why don't you use it? Try not to bruise it. My time, don't lose it. Why, yeah. Why, yeah. Why, yeah. Why, yeah. Why, yeah. Don't you use it? To reflect is a lonely child, just waiting in the cold. To reflect is in charge of finding treasure in the dark. Watching over that big clover isn't that bizarre? Every little thing the reflex does is an answer with a question mark. So why, yeah, don't you use it? Try not to bruise it. Buy time, don't lose it. To reflect is the time that child is waiting by the pole. To reflect is in charge of finding treasure in the dark. And watching over lucky clover isn't that bizarre? Every little thing the reflex does leaves me answered with a question mark. Ah, the reflex, what a game, is hiding all the time. The reflex is in charge of finding.
All right. Well, welcome back, everyone. I hope y'all had a good lunch break. And I hope you're buckled in for a good ride this afternoon because we've got the second long session that we've got scheduled for this week. Tuesday, you'll recall we had capital assets, and today we've got debt and long term liabilities. So, uh, obviously, those two often go hand in hand. And I would love to be able to cover debt and long term liabilities in a 50-minute session, but that's just not going to happen. So, in order to get all the material, we do have a long session. So, I hope you'll patiently persevere and stay engaged. We've got two past speakers rejoining us today. Josh and Leanne, welcome back. Glad to have you with us. And tell us what everything that we need to know for debt and long-term liabilities. The floor is yours.
Okay, can you hear me, Chris?
Yes, sir.
Okay, great. All right. Well, Chris, thanks for having us. And thanks to
Recording in progress.
everyone for being here. As Chris said, we've got a little marathon of accounting for debt and long-term liabilities here. Go to the next slide, please. There we go. Okay, so as Chris said, Leanne and I both presented before, but we'll introduce ourselves. I'm Josh Carroll. I'm a partner here at Bowman & Jenkins, and I spend my entire year working in state governments, and a lot of the participants that I saw on the list, so glad to see everybody here. And I'll let Leanne introduce herself.
Thanks, Josh. My name is Leanne Bagasala. I did present 2 years ago, but unfortunately I didn't make it to the presentations last year. I'm a director out of Malden & Jenkins Raleigh, North Carolina office, and I spend 100% of my time serving the state of North Carolina. So you'll see a lot of examples in the PowerPoint from the state of North Carolina.
Okay, so here's our agenda for the afternoon. As Chris said, it's all things debt, accounting for debt, long-term debt. We're going to look at just what are common debt arrangements, what do those local governments have, what debt instruments do we use to finance capital projects or just our general operations. Then we're going to dive into GASB requirements. What does GASB require us to record when we issue debt? How do we account for that? What disclosures are required for our long-term debt, and just ultimately why is everything that's in our financial statements in there? We're going to kind of dive into that and sort of dissect it. I'm going to take those two bullets, and then Leanne is going to take us through accounting for debt transactions. Really the debits and credits to the accounting world. How do we account for issuance of debt, payments of long-term debt, refunding, premiums, discounts, just all the debits and credits of debt. Then we're going to dive a little deeper into disclosure requirements. I'm going to look at maybe how disclosure requirements have changed over the years, what's new in disclosures, and just a little bit deeper dive into the disclosures. Then we're going to look at other types of debt. These are they're still common to local governments, but you may have none of these, you may have all of these, and you may only have a couple of these. And then we're going to wrap up with what's going on in the current debt environment, and just what else do we need to think about, kind of a potpourri of just overall debt thoughts at the end here. So, all right, we're going to dive in. So the first section, what is debt and common debt arrangements? We'll go on to the next slide. So, no matter how small or large our government is or how healthy we are, I think we're all at some point going to use some kind of debt financing over the life of a government. We don't have that now. Maybe we had some years ago, or maybe we'll have some in the future. We may need a large project, need some funding to finance it, or maybe an unforeseen circumstance arises and we need some funding to address that, or maybe interest rates are just so good, can't help but take advantage of those rates and leverage the financing with those rates. So I went out to Google, I Googled what is debt, and those two bullets are what popped up. It's the state of owing money, something that's owed by one party to another. GASB kind of further defines and articulates debt. It's a liability that arises from a contractual obligation to pay cash in one or more payments to settle an amount that is fixed at the date the contractual obligation is established. That's a mouthful, but that's GASB's definition of debt. I think we kind of all know what debt is. We enter into agreement to borrow money to purchase assets, and we pay those over in our personal life, many of us have car notes, mortgages, credit cards, or personal loans. Personal loans, maybe we borrowed money from our in-laws to make a down payment on our first home. If you did that, kudos to you. I don't want to owe my in-laws anything. So those are just the definitions of debt, and then we're gonna move on and dive into what is common debts for local government. So the most common debts we see at all of our clients and governments are bonds. Bonds are our largest source of financing. They're what keep us going, what help us finance big projects. Um, GO bonds, general obligation bonds, they're kind of exactly what they sound like. They're general in nature. They're not specific for any reason. We might issue a GO bond for a specific purpose, but generally we can use these funds for whatever we want to do with them. They're not backed by any revenue stream. They're just backed by the full faith and credit of your local government. Um, they might be issued at a par or a premium, a discount or a premium, excuse me, and that premium or discount is going to be amortized over the life of the bond. Leanne will get much greater detail on the accounting of that later in the presentation. And with GO bonds, sometimes there is a separate millage rate that we assess. Maybe we assess a millage and we're going to receive a separate millage rate of taxes to collect money to pay those debt service payments over the life of the bonds. And if and when we do finally pay those bonds off, that millage rate would go away. Revenue bonds, another really common bond. They're backed by a specific revenue stream, whether it's water and sewer or maybe natural gas or electric, whatever revenue stream is backing those bonds. We issue these bonds to make improvements, perform maintenance, expand our utility systems. Utility systems are generally expensive to maintain and need a lot of maintenance, and so revenue bonds are very common to maintain those systems. And they generally are associated with some kind of financial covenant, whether that's a debt service ratio or another covenant that your bonds may contain. We're going to get deeper into the covenants later in the presentation, so I'll kind of halt on that for now. Another common arrangement, finance purchases. They're kind of exactly what it sounds like. They're financing the purchase of an asset. When I think of these, I kind of think of maybe we're purchasing vehicles for our police department. And we go out and purchase the vehicles and we get a loan and we pay that over 3, 5, 7 years, whatever the life of the vehicle is. Those are very common finance purchase arrangements. I often see some kind of confuse this with leases in GASB 87. The difference here is the lease, you never actually take ownership of the asset. We're just paying for the right to use the asset over the term of the agreement. And when that's done, usually the ownership of the asset is finance purchase. We're actually agreeing to own the vehicle at the end of the agreement. Next slide. COPS, these are certificates of participation. I don't see a lot of COPS, but they are out there for the purpose of this presentation. It's just accounting and disclosures. We'll kind of leave it at that, but COPS are very similar to a bond from an accounting standpoint for us as a local government. Instead of being backed by utility revenue, they're kind of they're kind of backed by a lease revenue. And then everything I've talked about thus far, they're all long-term debt arrangements. We're going to pay those over more than 1 year. Bonds may be upwards of 30, 40, 50 years. But we may need at some point to enter into some short-term debt financing. I know this is titled long-term debt, but Leanne and I kind of thought these short-term debts were relevant to talk about. We see a lot of governments use them. And they're really a mechanism to kind of bridge the gap of a timing of when we need to have some funding for whatever reason, kind of bridge the gap of when another future event might happen. So tax anticipation notes, it's a short-term loan where maybe we're a 930 year in and we've kind of spent all our money. Maybe we've had a heavy capital, a lot of money on capital projects. We just need some money to operate until our taxes start coming in October or November. We can issue a tax anticipation note and we can use that money for operations until we do collect those taxes. A bond anticipation note, very similar. If you've ever been involved in a bond offering, they are not a quick process. They generally take a long time to get the bond issued. There's the local government's involved, attorneys are involved, financial advisors are involved, your auditor may be involved, doing some work on financial statements in the interim from your last audit to whenever we're gonna issue this bond. So it could take a long time to issue a bond. Maybe we've got a project that we really need to get going, and maybe we've got a favorable terms to purchase a land or a building, and we need the money, and we can't wait to issue the bond, so we could issue a bond anticipation note and go ahead and get that project off the ground. So, two examples there. We get the next slide again. And so, as I mentioned, these are short-term in nature, so they are not a long-term debt. These would be actually recorded in your governmental fund's balance sheet. And generally, we see those in the general fund, and then when the property taxes are collected, we would then pay off that debt, and we would reduce the liability from the balance sheet. So, Leanne is going to get way more in depth in the accounting, but they are short-term in nature. They're generally less than 12 months in their term. Next slide. The bond anticipation notes, same thing. They're shorter than a year. There's a few GASB 62s and GASB interpretation 1 year. If we issue a ban and we do intend to, kind of refinance that into a bond or refinance it into a long-term obligation, then in the GASB tells us that this would not be a short-term liability, and we would then treat that as if it was a long-term debt. I don't see that happening a lot. Most of these are, like I said, they're just bridging the gap, and we issue to get our project rolling off the ground. We then issue the bond, and then we pay off the ban in the short-term nature. So we can go to the next slide, and
I just wanted to mention here, I have a client that does bond anticipation notes, and they have $1 trillion bond anticipation notes at the end of fiscal year 2024, and they do have it as long-term debt. They use it to fund a lot of projects for the schools, and so they are anticipating switching it to a long-term basis and just kind of use that for general funding throughout the year as like the schools ask for the money. So it is something that's out there, but yeah, it's far in between that we see some of the clients use it.
you said $1 trillion?
$1 trillion, yeah. They have. No, I'm sorry. No, billion.
Oh, I would say that's
Mountain Dew.
That's a big number. I was
They
going to be
do have
impressed.
3.8 billion in total debt, but they have a 1 billion in bans.
Okay, wow. Interesting. Good stuff. Okay. We could go on to the next slide. I think it's our first poll question. So the tax anticipation notes are short-term in nature, recorded on the governmental fund balance sheet, or both A and B. And, while we're talking, or everyone's filling in their response there, we talked about bridging the gap, and I sort of had another thought on another bridge of the gap or SPLOST bonds. So if you don't know what SPLOST is, it's special purpose local option sales tax. And it's where we collect a penny and we use that penny to fund a lot of infrastructure and capital projects. And maybe we don't want to wait for that money to come in. We've got a big project and we want to start, and we can issue a SPLOST bond, and we can use that fund to get our capital project started. And then once the money starts trickling in from the 1 penny SPLOST sales tax, we can use that money to then kind of pay down the debt. So it's another arrangement. SPLOST bonds are long-term. I've never seen one in less than a year. Usually multi-years. Just another debt instrument that is out there. Okay. And yes, the answer to that was both A and B. Next slide.
Sorry, I can't figure out how to get it to go to the next slide. Oh, there it goes.
Okay, all right, so our next topic, we're gonna dive into the GASB requirements. What does GASB require us to record, and all the disclosures that go along with the debt instruments that we have, and why is everything that's in our financial statements there. So, next slide. Okay, so ultimately, recording the liability, I mean, if we issue debt, GASB requires us to report the face value of the debt that is outstanding, as of our financial statement date. Lost your screen for a second. So we're gonna report the face amount of our debt. We are required to report the current portion of the debt and a long-term portion of the debt. If you have a premium or discount associated with your long-term debt, that premium and discount is netted into the long-term portion. And these are reported up on the balance sheet or your statement of net position. The current portion, if you're a 2024 year end, your current portion would be what's coming due in 2025. And then your long-term portion would be anything after 2025. Let's see. You're not required to. You can lump all your debts into one current and long-term portion. We recommend breaking them out by type or classification, such as bonds, notes, or finance purchases. It makes it much easier to read the financial statements. It flows to the footnotes a lot better. Much easier for you as a preparer or anyone that you read from the financial statements. Kind of read them and dissect them. They flow a lot better. So we recommend that, but you do not have to do that. GASB 65, it's been around for a while now, but it did change the accounting for gains and losses on refunding. Deanne is going to go into that depth, but reporting and accounting standpoint, on the balance sheet, those will go into the deferred and closed out resources. They're no longer included as part of long-term debt in the liabilities. They used to be, but GASB 65 changed that. So the footnotes are going to be the meat of this section. When I think of footnotes, I just try to look at them as footnotes are designed to tell the readers more about the financial statements than they can gain from the face of the balance sheet or the statement of net position. All we can really tell from the statement of net position is the current portion and the long-term portion, but that doesn't really tell us much of anything. We may owe $10 million in bonds, and $1 million may be current, and $9 million may be long-term, but that $9 million may be due in year 2. We don't know. So it doesn't really tell us a lot. So the footnotes are designed to tell us everything we need to know about the debt instruments we have and our financial commitments to repay them. So numbers 1, 2, and 3 there, we're going to basically, in our notes, we're going to say what type of debt did we issue. Was it a bond? Was it a GO bond? Was it a revenue bond? Was it a finance purchase? Or whatever obligation or instrument it was. We're going to say what it was. We're going to say the original amount of debt. If we issued a bond for $100 million, we're going to say that we issued a GO bond for $100 million. And then we're going to say, what did we issue? Was it a GO bond for a specific purpose? Was it just a general bond for operating? Was it a revenue bond to improve water and sewer? Or was it a finance purchase to maybe purchase some police vehicles? So we're going to tell the readers, what type of debt did we use? How much was it? And then what was it for? Or what was our intention and our purpose for issuing the debt? And then we're going to continue to disclose, any bond covenants, or any debt covenants. It have to be bonds. A lot of bonds and debt agreements now have covenants. They're kind of designed to protect the lenders to make sure that they're paid. If we have any significant covenants, GASB tells us we need to disclose those in the notes to tell the readers what those covenants are and if we're meeting them, and if we're not, what is the consequences or the implications for not meeting those covenants. And so the first 4 there, they're very narrative in nature. It's literally a written sentence or paragraph. There's no amortization schedules. There's really no dollar figures other than what we out of the debt we issued. And the rest of it, we're gonna have, tell the reader the installment payments. How are we gonna pay for this? Is it monthly payments? Is it quarterly payments? Is it annual payments? What is that payment? And then how many payments are we gonna make? Are we gonna make annual payments for 30 years, or are we gonna make 30 months of payments, whatever it may be? Just to tell the reader the financial statement, how much are we gonna pay, what commitments do we have long-term for these payments to satisfy our debt. We're also gonna tell them what the interest rate is. Your interest rate may be fixed, it may be 3% for 30 years, it may be variable. You may have a rate that's the prime rate plus 0.5%, the prime rate plus 1%, and it may change annually, once every 2 years, whatever your agreement or arrangement is. That's what we need to tell the reader. And then we're going to disclose maturity of 5 years, in 5-year increments. Excuse me. We're going to show, if we're a 2024 year end, we're going to show the disclosures of payments for 25, 26, 27, 28, and 29. And then we're going to show 5-year buckets after that until we exhaust all the payments that are coming due. Next slide.
The clerk of the board.
We already talked about the 5 years, but we are going to also disclose principal and interest separately. The principal payment is the debt, it's the face value of what we owe. The interest is not a long-term debt, but it is an obligation, and it will be a cash outflow for us to satisfy paying our debt obligations. So we're going to disclose principal and interest components separately, and we're going to have the 5 years, the first 5 years, and then our 5-year budget after that. We've got some examples coming up here. So this is just a standard statement of net position. There's no headers here, but the first column is governmental activities, the second column business type activities, and then the third column is just the total of the first 2 columns. And you can see we have notes payable due within 1 year, notes payable due in more than 1 year, same for finance purchases and bonds. And so this is just the accounting. Like I said, Leanne is going to go into way more depth on that, but on the balance sheet, this is all we're going to see is what's due in 1 year for all of our long-term debt instruments and what's due in 1 year. And I do have deferred and closing out for the resources and the deferred charge on funding method. If you have those are not part of long-term debt anymore, they are in their own buckets here of the closing out of these. So the next couple slides are all footnote disclosures, just kind of some visual presentations. And like I said, you know, the notes are designed to tell the readers as much as we can about our debt obligations. And this one, for example, it's an installment purchase. It's very similar to a finance purchase. And the notes, if we read it, it says, A, it was an installment purchase. That's the type of debt. It was for $200,000. That's the amount we issued. And then it is for improvements to a municipal park. So we kind of satisfied those first 3 bullets. What is the debt instrument? How much was it, and then what was it for? And then we disclosed the interest rate here as well, 4.5% to 4.9%. And then all of that is a narrative. And then down below, we have the amortization of the debt. So in this case, we still owe the full face value of the debt, and that's because it was issued in 2024. Year end, and have no payment. And we have our 5-year buckets here, 24, 25, 26, 27, 28, and then the 5-year increments after that, and in full in 2043. We were to go back to the page. We don't have to do that again, but I would expect to see $10,000 as payment a year on installment purchases, and then $190,000 as more than this footnote was tied to the statement of position. So all of our footnotes should reconcile and tie to our statement of position and just kind of flow throughout the report. The next slide is a revenue bond. Again, this is just a visual example of a very generic footnote disclosure for a revenue bond. It's A, it's a revenue bond, it's for water and sewer improvement, it's for utility sellers, water rates are 5.25%, and then this is how we're gonna pay principal and interest over the life of the bond until it matures in 2024. Next slide. This is an example of disclosing the debt covenant. This entity issued a water and sewer bond, it has a debt service coverage ratio. The percentage ratio there is kind of left blank. We often see 1.2, 1.5, it's very common. And then here we sort of recalculated what's on the face of our financial statements versus the debt service that we paid, and then what is our coverage ratio, and hopefully we are exceeding that coverage ratio. But if not, we kind of have a debt covenant issue, and we're going to dive into debt covenants a little bit deeper later in the presentation, but that is just a general footnote disclosure example. Next slide. Okay, so in addition, in the notes, we're going to have a long-term debt roll forward, and the roll forwards essentially a snapshot of what happened to our debt throughout the year. Where did we begin the year? And if we issued new debt or entered into new any kind of debt commitments, we're going to show those as additions. Any payments we made, or if we extinguished some debt, we may be overfunding, we'll show those as subtractions. And then we will show a total ending liability for each different type of debt, and then we were also going to show the amount that's due in 1 year, and all of that should kind of reconcile and tie back to our statement of net position. We are required to report increases and decreases separately. We're not going to net them and just show an overall change. I know there was presentations on GASB 101. The GASB 101 does amend that for compensated absences. So if you choose to, you can just show the net increase or decrease for compensated absences, but our other debts, we need to show the additions and the deletions separately. And the next bullet here, this is one that I feel is just kind of overlooked. It's generally one sentence, it's right below the long-term debt roll forward, and it discloses what fund is going to be used to liquidate the liability. And GASB 101 does eliminate that requirement for compensated absences again, but I think this is an important disclosure. It's often overlooked. I'm going to make up an extreme example here, but if, let's just say, for instance, we're a city and we've got a general fund and it has $1 million in fund balance, and we think that's a pretty healthy fund balance because our annual expenses are only $500,000. So that would be a healthy fund balance. But maybe during the year we issued a debt for $1 million, and 500,000 of that is due next year. We've never had any debt before, and then this footnote is going to say the finance purchase is going to be liquidated by the general fund. So as a reader of the financial statements, I mean, that pretty much wipes out our healthy fund balance in one big whammo here. So I think it's important tell the reader what fund is obligated to pay that debt. In that example, it's an extreme example, but that would put a lot of pressure on that general fund, which may be okay as long as there's some other non-restricted revenues from other funds that maybe could be transferred to help the general fund pay that. So it's an interesting take on a 1-2 sentence below the debt roll forward that I think is probably often overlooked. Preparers and users of the statements may not really pay much attention. Next slide. So this is a visual example of the long-term debt roll forward, and again, it's just a great visual of what happened to our debt. Where did we begin the year? What debt did we add? What payments or refunds did we make to reduce those debts? And then what's our ending balance and what's due in the year? And as you can see with the arrows, those two columns should agree to the face of the financial statements or the statement of net position. And we should also reconcile these numbers with our footnotes, where we talk about the debts that we have, and then we amortize out the principal balance for the base amount of our debt that's still outstanding. And so like on this, and if I included the net position in the business type activities, I would expect to see $775,000 of bonds that are due in the current period. It does break it up between governmental activities and business type activities. Governmental activities is at the top, business type activities at the bottom. GASB does require us to separate those out between governmental and business type activities. Governmental activities is usually on the top. I don't think you have to do it that way, but that's generally what we see because governmental activities is the first column in the financial statement. So just kind of float. We got our next polling question coming up. So, which item is not a required long-term debt disclosure? The original amount of the debt, the interest rate, planned future debt issuance, or the amount of payments or installments? Leanne or Chris, are there any questions in the chat?
No, not yet.
Not yet. Okay. I do see a question in the chat. It says, do SPOS bonds require voter approval prior to the SPOS? The answer to that is no. The SPOS bond is issued against an already approved referendum. So the voters have already approved the SPOS and what projects we're going to spend that SPOS money on. And so the bond is just issued to kind of bridge the gap.
Josh, to clarify, in Georgia, you do have to approve the SPOS bonds as part of the referendum. So you approve the bonds and the SPOS at the same time.
Yes, that's correct. I kind of read the question as after the fact, but yeah, thanks for the clarification. And so the polling is up, and yes, the planned future debt issuance is not a long-term debt disclosure requirement. And we've got another poll question. True or false? A separate roll call report is required for governmental and business type long-term debt. Most everyone should hit this one.
I'm going to leave it open for a little while longer, Josh, but so far 84% have said true. If you want to keep talking while I leave it open a little longer, that'll be fine.
Okay. We can leave it open, Tom. So Leanne's going to take over now and kind of walk us through the accounting for long-term debt.
Thank you, Josh. I hope that, with Josh's presentation, you got a good overview of the different types of debt. They may not all applicable to your entity, but this is a good resource for you to be able to go back to and kind of review the different types of debt if you ever come across something new. But we are going to switch gears a little bit into actually accounting for debt transactions. So in the next 20 or so slides, we are going to be doing debits and credits on a Thursday afternoon. We will be looking at different debt sources and uses, documentation, and kind of figuring out, taking that and how do we get to what's recorded
If something is required to be recorded as a document by the county auditor,
Yeah.
who would I contact about if I want a copy of that?
If something is required to be recorded
As
by
a-
the county auditor.
Yeah, as a permanent document of the history of the county history. Specifically, what I want is the assessment for CRID 21. It says, according to Resolution 2016-191, that this document has been filed with the clerk of the board. And then according to RCW 36.32.110, it says the clerk of the board is the county auditor, unless the Board of County Commissioners designates someone else.
We have a clerk. of the
Oh, okay, is it,
Amanda.
oh, okay, so I need to reach out to her.
Amanda Pearson is the clerk of the board.
Oh, okay, so just reach out to her for the document.
Yeah, she'll have no idea.
Okay.
She's fairly new. I think she's been here about a year.
Okay.
But I don't know if she knows, but she is the clerk of the board.
Okay.
For the commissioners.
Okay.
Very fun. I love debt service.
But she'll probably be able to talk to somebody who'll know how to get it for her.
Might have, yeah, some insight of where she needs to go.
I'm surprised it's not in like any of our content manager databases.
We will kind of cover how do we get from a governmental fund to government-wide full accrual, but you do not record long-term debt on governmental fund.
Yeah, I'd contact her and just.
Okay.
Type activity like
Okay.
your water and sewer
Got
fund, that's on
Should I
full
CC
accrual
anyone?
accounting. And so you do record
No, I think it'd be
on the
fine. Just
statement
reach
of
out to her and see.
that
Okay.
If she wants to CC
your
someone to say, hey, I need a little bit more.
and the same thing with
assistance that she can.
government-wide,
Do you happen to know if we have a
those are
subscription
also
to
on
the Prosser
your long-term liabilities on the
bullet?
statement of
Yeah.
position.
Prosser Bulletin should be, oh,
So
no,
we're gonna
that's-
dive into
what's that to do?
modified basis of
Tri-City
accrual
Herald.
accounting a little bit more. Debt
Lorraine
is
usually sends
reported
out,
as an other financing source in the year you actually
an
issue
email
the
to
debt.
use,
The
but who's that
liability
with?
does not
Tri-City
be
Herald.
reported on the balance
That's what
sheet.
Tri-City
So
Herald.
whenever you
I would check with Lorraine.
Okay.
proceeds coming
Check with
in
Lorraine to see if
from
we have a
issuance of
Prosser
debt,
Bulletin.
those are recorded as
Because that's
other
our
financing source
official
in the year of issuance.
newspaper.
Yeah.
Sometimes
Whenever
you
we
have
post
a premium
official
or a
notices, it
discount
goes in that
related
newspaper.
to
Check with Lorraine
that
to see if we
issuance,
have
and
any,
that's also
because
Okay.
Brenda
reported
might
as
have
a other
a
financing source
user
for
like
use
that
in
we
the
would
year
all
of
use.
issuance.
But Lorraine would
Um,
probably know.
So
Okay,
to get into
cool.
a little
Thank
bit
you.
more about premiums and discounts, a premium is when a bond is sold at more than par or face value. And that's due to interest rates and fluctuations in the market. And then alternatively, a discount is the opposite of a bond premium, and the bonds are sold at a discount, meaning less than par value. And these are not netted on your statements. When you're recording the other financing source or use, you're recording them separate from the principal. But we'll go into a little bit more about actually amortizing those premiums and discounts in a couple of other slides, because there are different methods for amortizing those over the life of the debt. And then alternatively, when you have issuance costs related to those bonds and issuing that debt, those are expense in the year in which the issuance occurs. And we do have a couple slides that kind of go through, here's the transactions and how we record this, and specifically what is considered an issuance cost. From a modified basis of accrual accounting, when you pay the principal, when you're paying down that principal and interest, those are actually expensed as incurred. And when they're due and paid, there's no accrual of interest. When you go to pay that debt, let's just say you make an interest payment as of 4/30, and your end is 6/30. You wouldn't actually on a modified basis of accrual accounting, you wouldn't accrue those last 2 months. But we are going to go through an example of this specifically for a GO bond on the next couple of slides. But before we go through our example, I kind of wanted to walk through, like, where do you get the information in order to record your debt transactions? So I have one of my clients that actually has a debt department, and they have folks that do this all the time. So the finance people actually kind of get out of having to do all the reporting and understanding of the debt. But sometimes you might have like a financial advisor that helps you through those debt transactions. But the real thing that we look at, especially when we're auditing and making sure that you're properly recording something, is the offering document or the official statement, which you'll see referred to as the OS. And when you're recording debt, make sure you actually put a disclaimer one version of the offering statement. Sometimes there could be multiple versions of that. But there is a lot of different sources of getting information for your debt. We generally, when we're auditing and making sure the entries are posted correctly, we look at the sources and uses of fund document within your official statement. Your official statement should also include different things like your debt service requirements. What are your payments being made? Generally, you can get an amortization schedule that you can use in disclosures like Josh was just talking about. And then generally, you'll have some understanding, is there prepaid insurance or are there financial covenants within your official statement. So this slide right here goes through an example of a general obligation bond issuance. And so you'll see on the left side of this this slide where you have the sources of funds coming in and the uses of funds. And I like that this is a real life example of sense. Usually when we're posting journal entries, sometimes we don't round. But this one actually has sense. So this is a real life example for you. In this instance, they issued bonds for $17.4 million. There is accrued interest, which is the issuance date of this bond and the date the bonds are actually sold are different. So there is an accrued interest calculation here. They do have a net premium of $241,000. And they're going to take all that money that's coming in, and they're going to give some to, right here it says a capital project fund, but you can actually see off to the right that the proceeds are going to be recorded in your capital project fund. Again, this is a governmental fund example. This specific example, they have a debt service fund and they have a capital project fund, and they're recording these transactions in two different funds. They have in another fund, which is your debt service fund, is where they're going to record their accrued interest. And then along with the debt issuance, they have cost of issuance. These can be your financial advisor fee, your bond issuance company, or numerous things that can be in this cost of issuance. And then they have an underwriter's discount. This is a portion of the proceeds that might be withheld for underwriting fees, which is generally called your underwriter's discount. And you can actually see how those delivery date expenses of $241 agree to the net premium. It's a simplified example. But off to the right, you can see how this would be recorded. So in your debt service fund, they received cash, so they debited cash for $26,000, and they recorded accrued interest as a credit here. And then within the capital project funds, they recorded proceeds from the issuance of bonds with a credit, which is another financing source. They separately reported their premiums on bond issuance, which is also another financing source. And then they recorded bond issuance costs, which is an expense. And then they have the cash in the bank. They got the cash directly to them for $17.4 million. And obviously, your debits and credits here equal each other. And this is a simplified example. But now we're going to talk about how do we get this transaction from the governmental funds to the government-wide statements. So the impact on the government-wide statements, the GO bonds that we just talked about were recorded under modified basis of accrual, and they have to be converted to full accrual for the government-wide statements. All full accrual concepts discussed in the subsequent I can't say that word, slides must be utilized and accounted for in the government-wide statements, including the premiums and discounts. In order to do that, you have to do conversion entries. And every time you say GASB 34 or GASB 34 conversion, a lot of people, I will say, they turn their face up because I know I did too. When I was first learning how to do GASB 34, and a lot of people do it differently. I have a lot of clients that have a GASB 34 ledger or like a 9,000 fund or something like that, where they actually post debits and credits to a fund. I also have a lot of clients that do journal entries and like an Excel spreadsheet with debits and credits. Generally, when I'm writing financial statements, which I write about 15 a year, I do a template, which basically just kind of adds it. It takes the governmental balance sheet, income statement, adds in conversions with additions and subtractions, and that's how we get to the government-wide. So we'll talk a little bit about that in a couple of slides. But from a full accrual perspective, so this is on your enterprise fund, your business type, as well as your government-wide, debt is recorded on the statement of net position. So from a principal perspective, kind of what Josh was discussing, you do have to review your current versus your non-current pieces. Those should agree to your different debt documentation, and they should also, that current versus non-current portion should agree to your long-term debt footnote. And then as you pay down that principal is reduced as it's paid. From a premium and discount perspective, you're going to accrue those at the time of issuance, and then you're going to amortize any premiums and discounts over the life of the debt. So here you can see how we put in parentheses the effective interest method. So the effective interest method is the preferred method, and GAAP requires the effective interest method. However, you can use straight line, and I know that a lot of my clients use straight line just because it's easier to just take the total premium divided by the life of the debt, and that's what you amortize every single year. And that is an acceptable method to use if it approximates the effective interest method. But if it doesn't, then you kind of need to make sure that you're doing the appropriate method. So generally what I say to a lot of people is, hey, you should probably calculate this on the effective interest method too, so that you can know what the difference is between the effective interest method and the straight line method, just to make sure that you're not creating a material departure from GAAP. So you will see in our slide presentations that we say the use of the effective interest method. And then we'll go on to the next slide. In terms of issuance costs under full accrual accounting are expensed just like they are under governmental funds. And that includes your underwriter's discount, which we had as one of our examples when we were doing the debits and credits from a governmental perspective. And just so you know, I was honing in on when we were doing our example that you need to use the official statement that's the final version. Sometimes when you're actually going to record the cost, there could be an instance where the issuance cost doesn't agree to the official statement. So just kind of keep that in mind. And also when you're recording interest from the statement of net position, we have kind of mentioned this. Under full accrual accounting, you do record that interest, and then you could have variable, fixed, or range of interest that needs to be considered when recording that debt and keeping track of it. So this next slide here is a good example. It's the same exact numbers that we just went through. So I encourage you to keep these slides so that you can kind of look at the difference between funds, but the same information over to the left side. And this bond, this is actually a revenue bond, because generally we have a lot of revenue bonds with enterprise funds. But you can see off to the right, when they issued the bond, they recorded a liability or a bond payable. They credited that for $1.4 million. They also recorded a liability by crediting premiums on bond issuance. They have a liability for accrued interest. And then again, just like in the governmental funds, they expense the bond issuance cost. They recorded an interest expense, and then they recorded an asset for the cash that they received for the $17.4 million. So we do have our first poll question in the section that I am teaching. How are debt service payments, that principal and interest, recorded in a governmental fund, which is modified accrual, in the governmental fund financial statements? And I'll give you guys a second to respond to this poll. But in the meantime, if you want to drop in the chat if you have a debt service fund, because those are my favorite. So I just kind of wanted to see, is it general, do people use that, or is it just a couple of my clients?
Leanne, there's
I
a
like
couple
all the
questions.
yes answers.
Leanne, there's a couple questions in the chat.
Oh, okay.
Also,
So, sorry, I can't, I'm not really good at watching all of it.
one of them is are we required to disclose unused portions of bond proceeds?
Yeah, so your unused portion of bond proceeds, you'll actually see in your restricted cash footnote, is the place that those would be disclosed. Oh, the next one is really long. So So we're going to go over conduit debt in a couple slides towards the very end. Not a lot of the folks that we audit have conduit debt, but we do have a slide or two on that. So I'll come back to that question and you'll let me know if I didn't answer it or not. Okay. All right, so we'll go ahead and go on to the next poll question. Oh, sorry, did I tell you what the answer was? The answer is B. So debt service payments are expenditures in your governmental funds because you're not recording that liability on the balance sheet. Oops. Okay. And we'll do the next poll question. How is issuance of debt proceeds recorded in the business side or full accrual financial statements? And this one, we kind of went over this a couple times. The answer here is B. In a full accrual financial statements, you're recording the cash, you're going to debit cash, and you're going to credit the long-term liability. The answer A is specifically for a modified basis of accrual. Looks like you got that right. Okay. All right, so now we're going to go into the GASB 34 conversion. So if you need to drink your coffee, go ahead and drink your coffee because we're getting a little technical now with the GASB 34 conversion. And like I was saying, a lot of people do this differently. And so if you have a specific way that works for you, that's great. I would just continue to use that. There are a lot of templates out there, online. I know in the state of North Carolina, we have a template that's available to our local governments where they use that a lot if they're writing the financial statements. But the purpose of the GASB 34 conversion is to bring your governmental funds from a modified basis of accrual to a full accrual basis. And you can do that a couple different ways. So I mentioned there's a journal entry approach through a worksheet where you actually post debits and credits. And you just keep them in the worksheet. You don't actually record those to a fund. Some people have a fund that's specific for GASB 34 conversion. If you have one of those, you can just drop a chat saying if you have one of those GASB 34 ledgers. Those are always fun to see how people record those. And I do think it's a good method to actually use a GASB 34 ledger because it really helps people from year to year say, well, this is the entry that I posted. This is how I can take, let's just say like a general fund and kind of roll things up to your government-wide statements. And then most of the times, here at Mullins & Jenkins, we use a template when creating financial statements that takes the balance sheet and income statement from your governmental funds. We add and subtract different things to it that we'll talk about in the next couple slides. And then that kind of gives us another column that has your government-wide statements. And it has all these good checks and balances, and it has highlights on it that say, hey, this is equal zero. So they're really, really good method for keeping track of the GASB 34 conversion. And then as part of the GASB 34 conversion, when you are doing the reconciliations, there are two reconciliations that we're going to walk through. The first one is the reconciliation of governmental funds balance sheet to the statement of net position. And then there's a reconciliation of the governmental fund statement of revenue, expenditures, and changes in fund balance to the statement of activities. So those two reconciliations, generally, you just see them coming right after the governmental balance sheet or the income statement, and some people actually have them in footnote disclosure as well. So this clip right here is an example of the reconciliation of governmental balance sheet to the statement of net position. And I understand that this slide has things up there that are not related to debt, but in order to clip it and put it in the PowerPoint, I put the entire thing so you can see it. And so obviously when you're doing a reconciliation from, your governmental balance sheet to the statement of net position, you would start with your fund balance of the governmental funds. We're not going to cover the next two things, which are related to capital assets and other long-term assets, because we're teaching debt at this point, but these are things that may have been covered in previous training. That was, what was it? Capital assets was done yesterday, right? But we're going to cover the other things that are specific to debt. So the first one related to debt is your deferred outflow for pensions and your deferred outflow for OPEB. So if you have multiple pension plans, you could, put a little subtitle here and say this is for this pension plan and this is for this one. This specific GASB 34 conversion combines the pensions into one line, and then you also have one for OPEB. Now, when you are trying to find where do these numbers come from, so generally in your financial statements, you are disclosing the total deferred outflows related to pension and the total deferred outflows related to OPEB. And let's just say you had a deferred outflow related to pensions in total that was $5 million. A lot of entities actually allocate that $5 million of deferred outflows amongst the governmental funds and the business type. And so, a lot of employee, and it's done generally based on headcount, or it can be based on contribution percentages, but this number, this 4.883, would not always tie back to your footnotes, because your footnotes is going to be in total. So you can see on this next slide how I mentioned that you need to check your allocations. So the deferred outflow pension and the deferred outflow OPEB, it could be an allocation of the overall total. So those will flow through on the beginning part of your conversion reconciliation. All right, and then the next part of our GASB 34 conversion is adding in all the liabilities. So you can see off to the right how all the numbers are negative. These are all liabilities that are being added to the statement of net position. So the first one is some liabilities, including long-term liabilities, are not due and payable in the current period and therefore not reported in the funds. So these are all of the liabilities that we've been talking about, the general obligation bonds, and the limit obligation bonds, all those sort of things are added in to your GASB 34 conversion. And this $23.4 million number that you see here should agree to your long-term debt footnote. And then the next couple ones are your deferred inflows related to your pensions and OPEB. Again, it's the same concept as your deferred outflows. This is a portion that's allocated to the governmental funds, so it may not 100% tie back to the footnotes that you have. And then, in addition to your long-term debt obligations, that $23.4 million pot, you still have to add in all your pension and OPEB liabilities. So you can see here, this is actually an example from the state of North Carolina. They have an elderly plan and a LOSA for law enforcement, and then they have the OPEB plan. And so you can see these separately are being added. And again, these numbers may not tie back to your footnote per se because of an allocation, but then these liabilities for OPEB and pension should tie back to your long-term debt roll forward. And then the last item up here is other liabilities that are not due until the current period and therefore not included in funds. The example here we have is accrued interest, this $154,000 number. That is actually a calculation. So you have to have some type of template off to the side of how you calculate that accrued interest, and it becomes a conversion. So to summarize the walkthrough here, you have long-term debt obligations. Those should agree to your long-term debt footnote. You have your deferred inflows for pension and OPEB, which is the allocated portion for your governmental activities. You have your pension and OPEB liabilities that agree to your long-term debt footnote, and then you have other long-term liabilities like accrued interest. So I have a couple tips that I wanted to share when doing the GASB 34 conversion. So if you kind of look back at your conversion that we started looking at here, and you had the deferred outflows here that were reported separately, and then you had deferred inflows reported here, and then you have the liabilities reported here. I've seen some people who actually combined it all into one line. I like seeing it separately because it's easier for me to tie out, to the footnotes and the long-term debt footnotes. But I've seen some people that have actually combined it into one line. And if you were to combine it, this is an example of what you could say. Basically saying, in the reconciliation, the total OPEB liability and related deferred outflows and inflows of resources related to your OPEB plan are not expected to be liquidated. And just kind of have a footnote disclosure that includes all of those combined together. And then the same concept with your long-term debt obligation and accrued interest, you can always put those together. Now, when I do some of these GASB 34 conversions on this slide where you see some liabilities, I actually like to break them out because I'm just like one of those people that like to tie it back and forth to the long-term debt roll forward. But yes, you can do it in a summary level. I most likely see the summary level, but usually off to the side in my Excel, I might add them up to kind of show someone how I came up with those numbers and derive those numbers. And I'm not going to tell you where you should plug the GASB 34. But if you had to plug it, the easiest way would be in one of these numbers you can't tie back to the long-term debt roll forward. Not that we ever plug anything whatsoever. Never do that. Okay, so now we're going to go to the GASB 34 conversion. This is the reconciliation of the governmental fund statement of revenue, expenditures, and change of fund balance, the statement of activities. And again, this example, this is from a State of North Carolina example. They do things a little bit differently, but overall it's the same gist. You would start off with your net change of fund balance at your governmental fund. Here they have a deficit, so I would probably call this a deficit here. And then they do have some information related to capital assets that we're going to skip over. I did hear some of the training yesterday that was done, and a comment made about right to use leased assets, that this probably would get you a GFOA comment, because that's not what it's supposed to be called. It's not supposed to have a D on the end. But we'll skip over that again since we're not showing you where these numbers derive. But at the bottom of this conversion here, you can see that any payments made from your pension and OPEB plan do need to come through on this reconciliation to the statement of activities. And you can kind of see those here. This is the portion that is government-wide, your governmental funds would have paid. This first one I think is for in North Carolina. This is from Elders, which is a pension plan, Leosa, which is also a pension plan, and then your OPEB. And this right here is your walkthrough. Obviously, those contribution and benefit plans payments that you're making for your pension and OPEB plan, they may be an allocation of a total amount, so you have to make sure that you have those numbers correct. And then the other part of the reconciliation that we have, this first one up top is not related to debt, so we're going to skip over that. But then, if you remember back to our discussion on modified basis of accrual, when we issued debt in the governmental funds, we didn't actually book a liability. And so you do have to add or subtract the debt that you issued in this reconciliation, and then any payments you made against it needs to be included in this reconciliation. You can actually list out all the different types of debt if you really wanted to. So that it's easier to tie out or to put together. And then you also have to include the account interest payable, which is just the change in accrued interest payable. And then down here, there are some items reporting the statement of activities that are not required the use of current financial resources and therefore not expenditures in the governmental funds. Those relate to compensated absences, which we haven't covered yet, but we will get there. And then you also have your pension expense and your OPEB plan expense that needs to be added. And again, the pension and OPEB is your allocation portion to your governmental funds. This compensated absence is actually the change in the account. And we're going to skip over this last one where they consolidated their internal service fund. And from a walkthrough perspective, when you're doing your conversion to your statement of net position. Your debt that you issue needs to be effectively a subtraction here, but that needs to agree to your long-term debt roll forward. You also need to include your debt payments, which also agree to your long-term debt roll forward. You got a change in accrued interest payable, which is comparing current year to prior year. And then you have your expense impacts, which are your compensated absences, and then your pension and OPEB, which then ultimately be allocations. And then I have a couple tricks up my sleeve for the GASB 34 conversion related to the statement of net position. And my only real trick is that you can, again, consolidate different things like your long-term debt impacts. And here's an example disclosure that you could put, the issuance of long-term debt provides current financial resources to the government funds while the repayment of principal of long-term debt consumes current financial resources. So this is just a way to kind of consolidate and make the conversion a little bit smaller in numbers, but again, you still have to include everything in your GASB 34 conversion. All right, I think this is a good time to take our 10-minute break because we're going to switch off of GASB 34 and we're going to move on to a couple things specific to debt, which are still a little bit more technical in nature, but I think it's a good chance to take a break if that's okay with everybody.
All right, sounds good. Well, everyone, we will get started back here in about 10 minutes. So stretch your legs and shake the cobwebs loose, and we'll get started back soon.
Recording stopped.
Security shut through the wall. Our future dreams we have to realize.
This is 2023.
right. Just about another 60 seconds or so. I'll give Leanne a chance to reshare her screen, and we'll get started back as soon as they are ready.
Give me just a
Recording
second.
in progress.
Switch my screens. I had this working out perfectly earlier. Now I can't figure out how to get it off that screen. Okay.
Recording stopped.
Do you need a little verbal assistance there, Leanne? Oh, I think you got it. I think you have
Did I get it
yep.
now? Okay.
There it is.
Perfect.
All right, all
Perfect.
yours.
Recording in
so-
progress.
So now we're going to dive into a couple things that are specific to debt. So we're going to go through amortization, which we've kind of talked about a little bit here and there, but you can use these slides to kind of like bring it all into one thing. So there are two different types of things that we're going to talk about that need to be amortized. And the first is your deferred charge on refunding of debt. And we are going to talk about current refundings and advanced refundings, but if there are deferred charges, on that refunding, the difference between the net acquisition price and the net carrying amount of the old debt, then you need to amortize that deferred charge on refunding using the fixed interest method over the shorter of the remaining life of the old debt or the remaining life of the new debt. And so it's important to make sure you're using the correct term when you're doing that. And then we've talked a little bit about the premium discount. Premiums and discounts on bonds. You can use them, amortize them using the fixed interest method or the straight line method over the life of that debt. And if you're using the straight line method, just make sure that it approximates the effective interest method. And similar with doing your financing, you should disclose how you're doing that amortization. So just make sure that your disclosures are correct based on what how you're doing that. All right. So I mentioned this slide earlier when I was going through the different types of issuance costs and what those entail. So issuance costs split into commissions that need to be paid, legal fees, registration fees, fees from your underwriter, other things like training, which are some small costs that we incur to issue debt and underwriter's fees. All of these need to be expensed as incurred, and this change was implemented in paragraph 15 eliminated the amortization of issuance costs except for prepaid expenses. So when you're accounting for these costs, you would include them in any direction of funds, whether terminal or primary funds that get spent within the section of prepaid insurance. You just need to be mindful when you're reviewing, I should say, your authoring statement and other documentation related that if you had a prepaid insurance, those would not be expensed. So this is the first poll question that we have. This did kind of go along with SASB 34 conversion that we were just talking about. And the first option is A, which is not part of SASB 34 conversion. A would be deferred outflows for pension items related to governmental activities, or B, amortization of bond premiums and related fees. And that's really the job of these poll questions to kind of trick us on this one, because when I first read it, I was like, oh my gosh, this is easy. But we will cover this. So you should remember what is the GASB 34 conversion specifically for, and that's your NIC, what type of funding you use it for. And so we'll let you use your answers in for a few more seconds, and then we'll go through the answer for that one.
I think Josh did trick us because right now it is exactly 50-50 on the polling.
Yeah, gosh, I mean, I literally was taking notes and I was like, Josh didn't tell me the answers to these questions. And I was, and to see where I circled one of them and I scribbled it out. And I was like, oh, he was tricking me. So the answer here is actually D.
Oh,
But the amortization of flow premium is related to business type activity. And so the GASB 34 conversion is not for business type activity, it's for your governmental funding. So that's what, but I do feel like I honed in a lot on deferred outflows to pension and OPAP. Um, so those are included in the calculation. All right. And then we have a poll question two related to your issuance costs and what do you do with those issuance costs when you report them. And let me take a look. But I think we covered that several times. And also, Josh, in whatever mode I'm in, I can ask you those questions or answer you would like to answer them.
no, your turn.
Okay, so I'm going to go ahead and tell you the answer while y'all are getting in there. But the answer here is D. You expense bond issuance costs in all funds, but not pre-position. Okay. All right, now we're going to talk about refunding a debt and defeasance. And by the way, I cannot say defeasance to save my life, and I practiced it like 30 times. So if I say it wrong, I'm sorry, but I tried. So oftentimes, you get into a situation where you may have debt out there and you just decide that you want to issue new debt to replace your old debt. And that can be done for a number of reasons. I like to say that there are some debt managers out there that just like to issue debt and there's some managers that never for them. And so maybe that's supposed to be a bullet here. But generally, debt is refunded because you want to change the covenant. Let's just say maybe you have a burdensome covenant that's out there, and if you refund that debt, maybe you would get a different covenant that maybe isn't so hard to follow or keep track of. Also, you could refund debt to take advantage of better interest rates. Definitely with the changing of the interest rate market, maybe this is advantageous for a entity to refund their debt. And then from an interest rate perspective, maybe you want to go from a variable rate to a fixed rate or vice versa. We will kind of cover that a little bit later, what you could do is swap. And we do have a slide specifically related to that. I don't actually deal with swaps very often in North Carolina. Maybe Josh, you have some more experience on that, but there is option, obviously, to refund debt when you change the interest rate. We will go through what the difference is between a current refunding and advanced refunding in the next slide. But I did want to kind of hone in a little bit on what defeased debt is. And because I don't deal with this very often, I am going to give you a couple disclosure of what defeased debt is. So when debt is defeased, it is no longer reported as a liability. On the face of the financial statements, only the new debt is reported, and that is under GASB 34 paragraph 4. Most advanced refundings, which again we're going to talk about in the next slide, have a defeasance piece to it, and whether the debt can be legally defeased or in substance. A legal defeasance is when debt is legally satisfied based on certain provisions in the debt instrument, even though the debt is not actually paid. A substance defeasance occurs when debt is considered defeased for accounting and financial reporting purposes, even though the legal defeasance has not occurred. So I know that's a lot of information there, and maybe not something that everyone deals with, but that kind of gives you an idea of what that is. On the next slide, though, we do have a little graphic that makes it easier to understand the difference between a current refunding and advanced refunding. So current refunding is when your old debt is paid before it matures, and and that's generally within 90 days of issuance of the new debt or the refunding debt. So here you have new debt used to pay off your old debt. In an advance refunding, you're getting cash and other assets are placed into a irrevocable trust to be used exclusively for the determined future debt requirements of the old debt. So here the old debt is refunded, and that old debt is considered deceased substance. So why would you do this? I mean, we went through the reasons why you might do this, and this is obviously something that's a little bit more technical. Some entities do a lot of this. I actually have one county in North Carolina that loves to refund their debt, and they literally give us a white chart that has, here's the debt that I have, here's how much it is, and here's the new debt. And so we literally take a picture of it, a mental picture of it, when we're doing an audit to kind of go through, well, why did we do this, and what went away, what was added. But this example here is kind of the debits and credits. And again, this one doesn't have pretty numbers to it, but you kind of get the gist of the debits and credits here. When you're doing this refunding, if you had bond issuance costs, you would expense them as incurred with a debit. And then the payment, generally when you're refunding debt, that new money that you get that is going to pay your old debt gets held by the escrow agent, and that gets reported as other financing source, which is a debit. And then any proceeds you receive from your new debt, that issuance, is reported as another financing source, and then also reported other financing source for your premium. And I'm sorry, I forgot to mention that this entry here is for your governmental funds, and it's to record the issuance of long-term bonds and the payment to an escrow agent. From a proprietary standpoint, this generally is a little harder to look at and read, but there are debits and credits here based on what type of what's going on. So remember, under your proprietary funds or your full basic accounting, you do record a bond payable. So you do have a debit and credit here for your old and new debt. And you are expensing your bond issuance costs as incurred. When you do this under full accrual accounting, there may be a gain or loss on your refunding. And so you would debit a loss and you credit a gain. And then again, if you had a premium or a discount, there would be a debit and credit related to those. I'm sorry that this doesn't have numbers to it, but at least you have a debit and credit that doesn't have to calculating that. The next slide is related to the deferred gain or loss on refunding. We mentioned how that gets amortized, and this slide here kind of summarizes that. For current refundings and advance refundings resulting in ceasement of debt reported by partial refunds, so this is full accrual, the difference between the acquisition price and the net carrying amount of the old debt should be deferred and amortized as a component of interest expense over the remaining life of the old debt, had it not been refunding, or the life of the new debt, whichever is shorter. That's a big sentence that basically says that when you're calculating that deferred gain or loss and refunding, it's the difference between the reacquisition price and the net carrying amount of the old debt. We do have a slide that kind of shows you what the calculation of the net carrying amount of the old debt is. And the difference between those gets amortized over the life of whichever is shorter, the old debt that was refunded or the new debt. And then here you can see that we did include a bullet that basically says if you use straight line amortization of that deferred gain or loss on refunding, it is acceptable in a systematic and rational manner. This slide right here goes through if you did do that refunding and you needed to calculate what the net carrying amount of the old debt is. That is the amount due at maturity, adjusted for any unamortized premium and discounts related to that old debt. So this is the net amount of that old debt minus the reacquisition
I'll be back.
deferred gain or loss. For current refundings of prior refundings and advance refundings of prior refundings resulted in the difference that is determined in the previous discussion together with any unamortized difference from the prior years' prior year funding should be deferred and amortized over the quarter. So sometimes when you have debt that is refunded and you refund it again, then it's still a gain or loss in the refunding. So this CNFP just kind of tells you how to make sure you're calculating that deferred gain or loss and how you're properly funding it. Alright, so we do have a section related to gain or loss on refundings and how it should be amortized, and hopefully the skillmatrix covered this in like 30 seconds. Do we have any questions, Josh?
There are none.
Okay. Either y'all are asleep or I'm just doing such an amazing job. Y'all have So the answer here is C, the shorter of the life of any debt or the remaining life of the refunded debt. And y'all got that one right. All right, I think it's your turn, Josh.
Okay. Okay, well, so we started out with, what debts do we have, and then we dove into disclosure requirements, and then we answered the nuances of all the debits, the credits, the reporting, and the transactions. So we're gonna dive a little bit further into the disclosure, not just our general, let's amortize this and cover what debt we have. We're gonna look at the disclosure that go along with long-term debt, and maybe how has GASB refined and maybe updated kind of address some current environment in the world. Next slide. You can actually kind of switch it out. But just a reminder, still the disclosures, their purpose and the reason we have them is to tell the readers as much as we can about our debt agreements. So a little bit of a refresher here. We're going to disclose the requirements to maturity. Initially, and after that. One thing we see is that we do need to disclose bonds and notes and finance purchases. We have seen a lot of financial statements where they just kind of lump them all up together, and they may have a narrative that says we've got bonds, we've got notes, we've got leases, we've got finance purchases, and then here's the amortization of all of our. That's not really a part. There's no way for a reader to kind of say, what do we owe on bonds? What do we owe on notes? What do we owe on finance purchases? So we need to kind of separate those out. We can combine them, like total bonds, for all of our bonds, total finance purchases, but we don't need to combine bonds and notes and finance purchases. Any other separate debt. The principal and interest components are separately. One comment I wanted to mention here that we see from GFOA when they're reviewing taxes is if you have a Series A and B bond, those are pretty common. If you've issued a bond instead of a 2024 A bond, your tax exempt, and if you issue a bond, that portion of the bond proceeds is not tax exempt. The bond update. We see a lot of those that combine those. As far as the roll forward of the long-term debt, the roll forward is kind of a picture of what happened with that during the year. all the 100,000 of the sinking bond, whatever it is, tells you about the transaction. And, most of the refundings are to save money, it's advantageous to us, a better term or a better rate, and Gatsby wants us to disclose our economic gain or loss on that refunding, basically how much money did we save. That disclosure is only required in the year of refunding. So you see it left in for a number of years, I don't think that's appropriate, because it's always good to tell the readers as much as you can, but disclosing the gain or loss is only required in the year of the actual refunding. And then when we refund the debt, we end up with a defeased balance at year end. Those 2020 bonds that we defeased with the 2024 issuance, they're no longer on our books, but those bonds still exist. The bondholders are still owed that money. Given our money, we've given our money to borrow proceeds to the trustee, and the trustee will continue to pay the bonds. So we need to disclose how much of it is at the end of the year, if this is the aggregate remaining balance of these bonds is debt. Simple as that. And we're going to continue to disclose that every year. That number should go down as the trustee pays down those bonds, or those bonds mature, or they are called for the reason. Next slide. So conduit debt. Conduit debt is not to use the word conduit debt. I typically see these in development authorities. A developer comes in and builds a multi-use development. And they use our development authorities to issue a bond, as well as fully tax exempt or partially tax exempt, and they're using our developer to issue a bond. They are not our developer bond. They are a bond as a developer. We're kind of involved in that transaction. Our development authority, Gatsby, has decided that we need to disclose those relationships. We need to enter a description of the conduit debt arrangement. What is it for? What are we doing with the money? How much conduit debt was it? And then the big one is how much is outstanding at the end of the year, and a clear indication that we, as the primary government, we have no obligation to this bond. The aggregate amount outstanding, we used to see a lot of disclosures, $1 million in conduit debt, and we don't have any idea how much is outstanding. Our financial reporting. Gatsby kind of said that's not going to cut it. They issued that warrant, and from Gatsby, they won't say that. We have to go to the amount. And I would say sometimes that is hard to obtain, because they are not our bond. We're not responsible for it. We're not paying for it. And so as you do your audit, if you do have conduit debt, try to either stay in contact with the parties throughout the year, or at least begin that process from the month beginning. I've had quite a few of them. They really ask for that information. Guarantees. I'm not going to dive too much into Gatsby 7. Gatsby 7 deals with guarantees. We're simply talking about disclosures. We'll just kind of assume that we are not on the hook to pay a guarantee. I see a lot of these examples in downtown development authorities. So Gatsby wants us to disclose that relationship. Again, it's all our development authority issues $20 million. Essentially, we have to pay $1 million if they're underpaid. So Gatsby has also collection of assets, against the debt, with that. And then the big one is, default events, consequences, terminations, and subjective acceleration clauses. These are credit ratings and risk things that, Gavin thought was important to disclose, not, I guess, handled consistently across the government world. A lot of these, events and termination clauses are in the arrangements of government entities. So if we have those, that we want to disclose. I think we have a debt offering coming up. Short-term debt arrangements require disclosure if no amount is outstanding.
Oh, she's on the phone.
Josh, you got another 50-50 going here on this one. You got about 30 seconds left.
Well, I mean, we have really good numbers left. Well, I mean, it might have been tricky, but these were only two options. You made two options.
A few more seconds left, and false is at 51%. So it's about an even split on this one too.
I kind of thought that one was going to have the answer here is true. We do have to disclose our as much as we can about short-term is not a long-term debt. It would be a long-term
What's it called?
okay, so I did mention GASB 88. GASB has been around for several years now, but a lot of regulators entering into contracts that had certain stipulations and limitations, things that just might start credit rating. So they kind of tweaked a bunch of the disclosures. GASB 88 is 100% disclosure specific. It doesn't have anything to do with accounting for liability, balance sheet, clarifying our long-term debt. Other debts, in the direct warranty, direct placement strategy, where we might just go to our local bank and get a loan, or maybe we go to a couple of different banks there versus, we already talked about lines of credit, collateral, and the specific terms of default, termination clauses. Those are GASB 88. We've got the example pages coming up. Next slide. There we go. So these are some sample footnotes. Here's the kind of things notes borrowing and with collateral from international apply. So that's the asset pledge. Sure the debt. So I kind of dive into default and subjective acceleration clauses. I don't see a lot of those, and I think they are exempted into default, but definitely here, I don't see a lot of clauses, but default. Scary, but I don't know that there's actually technically back that up. Some of them have, but so that's the gist of this discussion. And so here's the breakouts from the disclosure. So this is very similar to what we looked at earlier. This is our long-term debt roll forward and amortization schedule for the 5 year. And you can see how we kind of added note payable from the red bar over there, and how that is like separated from the bond. You had our bond. You have another bond with a bond. It's kind of showing the reason. So I didn't know if I did the entire session on this when I put this together. So I know you guys already heard some of the book. I just wanted to mention that in the debt book, and there are other companies that provide services to help us with the amortization schedule in the debt book. There are third parties that help us generate this disclosure and dive into our agreements and our ways of that flow. Which of the following is excluded? I don't think I actually said this, but it was on the slide.
And Josh, while they're doing that, I'll just go back to your previous slide and say the module for debt in debt book, at least in my opinion, it's actually superior to the leases and the Savitas module. It's a very good product. It will actually calculate, to Leanne's point, it'll actually do the effective interest rate calculation for you as well, which can be done in Excel, sure, but it's a lot easier if you have a dedicated software that does that. So it's a good product. Go forward your amortization schedule, all of that for you. So I'm glad you mentioned that. I'm not paid by them. I don't get any commission by them, but yes, their debt product is very good.
I like to say it also has the only downside I've seen is that if you pull out like the calculation, you're getting a hard number and formula to break it. But I've had several people that have like past year calculation, and we're using debt book to provide that round calculation just for us to like recalculate to make sure it works correctly. So I think it's a really good tool. Debt book has been very helpful. And the good thing about debt book and some of the other things that are out there is you can give your auditors access to see anything, and so they can go in there and pull your roll forward schedules, click on the lease agreement, click on the new debt agreement, and it kind of helps a little bit with having to provide this to you if you use different types of methods to reporting exercise, capturing in Excel or something like that.
That's a very good point. The auditor access is really nice. Kind of hands-on with the auditor. Okay, so we're gonna go in now. We're gonna go into that other debt category. And we looked at bonds, leases, financial leases, and we're gonna kind of dive into things that are still common. Not all of these, they have one of these, they have been mature or just change from time. So I'm gonna start with pension and OPEB. We're just gonna kind of do a refresher on pension and OPEB. We're not gonna dive into the details. I'm gonna talk a lot about pension, but standards are very similar, especially so talk a lot about pension. So first, the net pension liability. This is essentially it's an actuarially determined number for the liability, and it includes the cumulative assets differentiated numbers, which is the assets exceed the liability. The opposite, we have a liability. Most of us end up with a liability, but I do see assets here or there. On the OPEB side, there's kind of two liabilities, the total OPEB liability, or the net OPEB liability. If you're administered through a trust, you have net OPEB liability. If you're not administered through a trust, you have the total OPEB liability. Focusing on the balance sheet standpoint, if you have a net OPEB liability, it is shown 100% long-term for that long-term debt category we talked about. Total OPEB liability, it's not an actuarially number, so what we are looking for most of our clients. The next slide. So, chapter 67, this is our plan level statement. Chapter 67 kind of accounting, funding, and here in the plan level statement, this is the trust fund. This is the financial statements of the plan itself. Accumulated on the income statement side, administrative expenses we pay, so in these statements, we don't book the net pension liability or even close of outflows of usage. Those are booked only, and many other elements of the RSI, OPI substitution, that variable and so GASB 68, this is our sponsor level statement. This is your statement of net position under governmental activity. It may be allocated to governmental activity. And Kat mentioned that earlier. We are going to book our liabilities here on the balance sheet itself. We're going to report our inputs and outputs and resources. When we look at these, our common drives our more exposed to COVID and people that were staying home, all came out of it. the net pension liability in the middle there. Actually, this mine does have an statement. This goes with the measure, your measure of financial reporting date, goes in the middle here. Our pension liability actually measured adds up. The actuarial assumptions here in the middle, exposed inflation, cost of living adjustment, effective date of return. There's some other ones, key assumptions. And these all come straight to the actuarial report. Calculate, determine the actuarial equal, all of this information. As part of the reports that you're paying into the discount rate, goes there, and we want to talk about that in the slide. Next slide for me. Trying to watch our time. So this is the change in the net pension liability. It's very similar to the long-term debt roll forward. Actually, the net pension liability column, the ins and outs of that are actually in the long-term debt roll forward. This is a long-term item. Classified as public in this presentation.
Nine
Just kind of shows what
will
happens.
be traveling to the Meadowbrook Estates to notify residents there. Following up on the Ritchie School Board, where a vote to eliminate their race and curriculum policy just held today. Tony? This decision, in a statement from board members, they say that they remain committed to They emphasize that students should continue learning social studies, civics, and U.S. history in a non-partisan perspective, free from political or personal bias. Also, in local education news, public schools are being to better control access to the school building and significant changes to traffic patterns for safer, more efficient student drop-off and pickup. To minimize disruption to education, the district has scheduled the work to be done in a summer blitz project, so construction that will start and finish during summer break. And of course, staff in Washington is taking bold steps to fight climate change, and today is by cutting methane emissions from landfills.
The key ones here are assumptions.
As a greenhouse gas, more than 80 times more potent than carbon dioxide in a 10-year period. Methane alone is responsible for over 1% Three buckets or categories of funding that are compliance related are specifically for compliance and design planning. We also offer funding for monitoring as well as gas collection.
Some of them was there, but I'm going to move on.
News out of Richland this morning. Have you ever looked down an airport runway?
Anybody about it?
This I do not ever know.
Requirement to show temperatures as that but this kind of just shows a snapshot of the trend. Where's our future plan? Where was it go? And where is it now from a funding standpoint? And then what really drove that market? Did we get lucky in the market? Or maybe lucky intentionally on our pension board? kind of see how this goes, how the this county is there, they have an access, they don't rely on the ATM, look at that, you're looking at investment income, at the year, that was pretty much all laid out by investment law. Kind of interesting to see, what our banking plan is. Next slide, please. And then these are contributions. Your actuary is gonna actually calculate what they recommend that you plan, and you may contribute that amount to the dollar, or you may contribute more here, and ultimately, we're kind of showing it to this other field is how much of our salary goes to our pension. Well, that's it on that one. I think we got a poll question. Inflows and outflows of resources for pension are only disclosed to 10 level and not reported. Reported to the policy level or both.
So about halfway through the timer, Josh, 70% all of the above.
That is the correct answer for this one. Good job. Paying attention. I think we're gonna have a poll question on the number of years required to be renewed in the RS5, 5 years, 10 years, 10 as available, 14.
And again, halfway through this one, a lot more consistency. Again, 73% with 10 as available.
How much more time do we have? 35 minutes.
Yes, that is correct. 340. Yep, 340.
At
Okay,
this,
Leanne's
another
gonna take
calendar.
over from here. And 10 as available was the correct answer for the last question.
All right, thank you, Josh. So I'm going to cover a couple more types of debt. And so the first one I'm going to cover is GASB 87 leases. And I know you're so excited to continue to have to record, but what's the purpose of GASB 87? The Governmental Accounting Standards Board issues GASB 87 to improve lease accounting and financial reporting. Essentially, GASB took the approach that if you have a lease, you're financing the right to use an asset and therefore a liability and also an asset to be reported on the statement in that position. I think a lot of us have gone through this and dealing with this for a couple years so that we know the most common types of leases that are included in GASB 87 are your buildings or portion of the buildings that you may lease, like an office space. Generally, I see a lot of vehicle rentals or leases, such as your enterprise leases. And then sometimes you see equipment and copiers that are also reported as GASB 87 leases. And so how do you actually treat those GASB 87 leases? So if you're leasing the asset, you have a lease liability, which is calculated as the present value of lease payments less any incentive received. And then also other things that you have to add to this. So you add variable payments to that, whether they're based on an index or they're fixed construction, some residual value guarantees that you added to that, purchase options, penalties, and then any other payments that you're expected to pay to use that underlying asset. So when you're recording that lease liability, we've talked about the different methods that you can potentially use to do the JASI 87 calculations and different softwares out there that obviously help you do those calculations. But then there's also a lot of good books that are out there. When you're reporting those lease liability payments, those need to be discounted to the present value using the rate of the lesser charges to the lease, whether that's incremental interest or not, or you need to use an incremental borrowing rate. I know that when I was looking at the debt service this weekend, that rate does have an incremental borrowing rate. Do a calculation if you don't have an implicit rate, or that incremental borrowing rate should be the best estimate of the rate that would be charged if you were borrowing a similar amount during the lease term. And then the offset to your liability is your right to use lease asset, and that should be reported as the amount of the initial lease liability plus the amount paid to the lessor prior to measuring the lease liability plus incentives and other items. Generally, your right to use lease asset approximates your right to use liability. And then that lease asset that you are reporting to be amortized in a consistent, rational manner over the term of the lease. From a disclosure perspective, this disclosure that we have here is just a snip from a financial statement that we prepare. And I remember when JASI 87 originally came out, and a lot of the disclosures, they kind of look different from state to state, but in North Carolina, it seemed like everybody put a paragraph on every single lease that they had. And it's kind of evolved over the years, but this lease and what you have and are required to disclose is the term of the lease. And you can see this example that we have here. Here's a state 16 lease with an initial term of 120 months, and they have 2 months remaining to the fiscal year. You also have to disclose the payment amount and the rate that you are using, and generally the balance at the end of the year. So in a perfect world, if you had multiple different paragraphs and disclosures that have this information, and you added up the liability balances from every different paragraph, it should agree to what you're reporting on your long-term debt roll forward. I've seen a lot of people that do this in paragraph form, but I've also seen a lot of people that have tables in their financial statements that have the exact same information to kind of cut down on the number of pages maybe that are in their statement. But at the end of the day, you just have to make sure you have the term of the lease, the payment amount, the rate that's being applied, and the balance at the end of the year. And then in addition to that, you need to show the lease payment. You do similar to debt, you would have 5 years being disclosed, and then any additional years would be an increment of 5. Your principal payments that are showing here in the recent or the next year and here in the fiscal year 2024, that principal payment of $16,547 to show up as the current portion of your lease liability, and then again that 61,906 to show up in your long-term debt roll forward as the total amount of lease liability. And then we'll turn to JASI 96 related to CEDAs. And the purpose of this is just to make sure, or this is to make sure that you're providing your financial statement keepers with information that's relative related to your subscription-based IT technical agreement. And those are when you have contracts that convey the use or the right to use another party's CEDA or CEDA vendor's IT software along or in combination with a single capital asset for a specific period of time in exchange or exchange-like transaction. So all of you should have already implemented at this point JASI 96. And to determine whether your contract states control over the right to use lease asset or the IT asset, you need to understand a couple of different characteristics, which are here in bullet form, but the right to obtain the present service capacity for the use of the underlying asset, the right to determine the nature and manner of the use of the IT asset, and if you have any services like IT support, those are not included in the CEDA liability. But when you are booking the CEDA liability, you need to determine the term in which you have right to use that asset as well as if you have a non-taxable right to use that asset. Just like with GASB 87, we do have some things that we need to reassess. Specifically, this is related to Sabita. So at any time during a contract where you decide that things have changed. So for instance, if you originally looked at your lease and you said, hey, I'm not going to use that extension option in my lease. So when you originally recorded your Sabita liability, you didn't include that exercise option in there. It's been, several months. But then later you decide, oh, I am going to extend, and you need to reassess your Sabita liability. Same concept in reverse. You had originally booked your Sabita liability, and you said, I am going to use that extended period, and then you later decide not to, and you would need to reassess your Sabita liability. From a recognition perspective, the Sabita should be reported under the same provisions of GASB 87. You record a subscription liability and a subscription asset, then your full failure. And then we don't distribute the disclosures related to GASB 87. They're very similar to GASB 96. They're the same thing as the GASB 87. It's in a couple of previous slides. That's your high-level overview of those two. Next, we have compensated absences, and I know that you just had a training of this on Wednesday, so we're not going to hone in too much on compensated absences, but compensated absences generally are recorded on a statement of net position, the estimated balance to be due within 1 year, so on your proprietary funds or your government-wide is where you see those compensated absences. Let me give you an example here. This example disclosure has what we just covered. So we went through leases, which is the second row of this disclosure. And for this entity, they had additional GASB 7 leases year in the amount 261, and they have a current portion. So they're properly reporting a current portion of their lease liability. The same thing with their Sabita liabilities. They're talking about IT subscription liability. We have a beginning balance, so increases and decreases with their current portion. I did note this when I was looking through this slide, that this compensated absence here in this disclosure that's reported right under the IT subscription liability, it doesn't have a current portion. And generally you would report a current portion of compensated absence if it's, if it's material. I would suggest that, you do report one. But for some reason, this example does not have a current portion of your compensated absences. Right now, from a disclosure perspective, Josh did cover this, but right now is below your long-term debt obligation. Roll forward, you generally do say where compensated absences are liquidated out of, and that is in the new GASB 101. Okay, so next we're going to go through your claims payable. Not everybody is going to have a claims payable, but if you do have a claims payable, there is a required footnote disclosure. This one specifically shows your health claims payable liability here, but you could have separate disclosures, like if you have like a workers' comp claim or just any different type of claim, you would show this disclosure of unpaid claims at the end of the year. And obviously, it has a beginning balance, your incurred claims, and payments, because you ultimately see what the end of the year. When we actually audit something like this, we actually use information from the insurance company. We use the last sales tax to kind of get back to what were the claims payments and possibly what could be paid at the end of the year that you may not know about right at year end. The next item that we're going to cover is your arbitrage rebate, and the IRS requires a calculation on tax-exempt debt in order to pay a penalty if the interest earnings exceed your interest payments. So this is becoming more and more prevalent with our clients because they got tax-exempt debt and they're actually earning more money than they would have paid. And so this calculation, usually we actually specialists that are calculating this arbitrage rebate, that is required to be paid after 5 years after issuance, and then increments every 5 years thereafter. The arbitrage rate is required to be reevaluated annually for financial reporting, and that is actually part of your long-term debt position. So this wouldn't be on your governmental statement. This is a full accrual type of liability that you would report. And again, this is coming up more and more with the rate increases. We do have a poll question here about arbitrage rebate and whether or not it should be on your long-term debt report. And I'm going to let you guys go through that. We're in the interest of time. I'm going to keep going through the slides and explain we'll come back to that. So this is one of the questions that we've had come through related to conduit debt, and Josh did cover the concept of conduit debt. So this slide is a summary, but conduit debt is when someone takes out, or your entity takes out debt for the purpose of providing capital for a specified third party. And that actual debt is not recorded on the issuer's financial statement. So I think the question that we had through would be whether you would report it and would it work through your value report, and it would not. It is a disclosure only thing. The issuer of that, so if you say the local government, doesn't have an obligation to actually pay that debt beyond doing kind of a third party. So it is not reported on your financial statement, only disclosed. Well, this is my fun one. Debt derivatives, interest rate swaps. I think I mentioned earlier, I have been doing this for 16 years, and I do not recall ever having to do interest rate swaps. So if y'all have questions, I'm on the stop for the rest. But this slide basically just kind of teaches you a little bit about what it is. And often governments utilize the ability to offset their variable rate debt to get fixed rate debt. And you could actually switch that over to the other way. You could potentially go from a fixed rate agreement to a variable agreement. And interest rate swaps are typically derivative. And so the accounting for interest rate swaps is covered under DAS 53, which requires the value and the reporting on your statement in that position. You also have to determine if you're hedged in the sector, and there are certain risk disclosures that are required in your financial statement to properly disclose your derivative and what you are dealing with. And the last slide that I have related to other debt is related to landfill liability. And we actually deal with this a lot in the state of North Carolina. So what I mean by landfill liability is the closure and post-closure care costs that an entity may have because they operate a landfill or more than one landfill. And generally this is something that is reported and kept track on based on how many permits you have for landfills. But the entity is required to follow different federal laws, federal, state, and local laws related to the different costs to maintain that landfill as it is operating, and then also once it's closed. Generally, I see a landfill liability is the closure and post-closure care costs reported in a landfill fund. So an enterprise fund. And so you'll see an example below where we have a landfill. This is actually a debt roll forward. So it has at the beginning, addition, solutions, and the ending. And then the very far right column is your current fee. So you can see the ins and outs of the landfill closure and post-closure costs. When you are reporting a landfill closure and post-closure care costs, you should evaluate it every single year. It doesn't mean that you need a specialist technically to go in there and revalue what your costs are going to be every single year, but you need some type of evaluation from an outside party that says this is what it's going to cost to close my landfill and the closure costs. You need to reevaluate that. And so let's just say that you had a landfill study done a couple years ago. You would need to inflate that every single year using an index. And then also just make sure when you're doing the calculation for the landfill that you're considering how much of the closure cost, like how much is actually used of that landfill. So not just use 100% of the liability, taking some portion based on the usage so far of your landfill.
kind of lost. They have no idea how to record it, what they can think about it, what all else goes along with that other booking reliability, certain bunch of equipment, but we're gonna kind of talk about some other things. First slide, if you issue an actual annual financial, comprehensive financial report, you will have some add in debt. Never had any debt before, you will have to add to your financial statements. We see this a lot with maybe they don't have an actor, they don't file an actor, so they get or if you've never had debt, you can have to add in. The statistics section does require us to present in years of data as it's available. If you don't have to add until you accumulate. But what is in the stats? Debt, especially about paying debt by type, and this is really just a summary of what we're going to talk about. This is type activity. But the difference is it's just more data. It shows the numbers. So a reader of the financial statements, the reader of the financial statements bonded debt only, old bonded there, not all debt, debt, and our property. There's also in the stats section related to debt, there's direct and overlapping governmental activities debt tab. You may be the city and you've got some debt, and maybe the school board in your town or your city or area has some debt, county debt. So we want to show the overlapping debt is on our overlapping our operating the overall county. To disclose that, you have to gather that information by either looking at the other financial statements or asking your peers at those other entities. And the legal debt margin, I think that's probably the most important. We all have a legal debt margin when we issue some debt. Usually see 10% of our property tax value, and it just kind of shows us what is our current property tax value, and we get 10% of that. And we compare it to the debt that we have outstanding, and it just kind of shows the reader how close are we pushing on that margin, how much margin do we have. So those are the stats that go along with issuing debt. The next slide are debt covenants. I'm going to quickly go through some, but if you have utility bonds, we sort of mentioned this, the lenders have covenants to kind of protect their interests and try to make sure they get repaid. The big one is debt coverage ratio, and we see typically 1.1, 1.2, maybe up to 1.5, but whatever your lender puts in there, I'm happy to maintain that. It is a calculation direct from the face of the financial statement that's over there in the box on net operating income compared to our annual debt service obligation. The operating income excludes non-cash items, depreciation, amortization of bonds, discounted premiums, any non-cash item. It just shows how much is our utility, what operating income are we generating, and how does that compare to our annual obligation. It doesn't. We've got some issues. Inflation, behind in the audit, and it does make it extremely difficult for them to do that. Behind in the audit, it's gonna be parity bonds, I think the parity bonds recently, had done this for a really long time before that, so they're popping up. The parity bond is broadly, it's two different bond issuances, against the same utility system. They're typically water and sewer, but it's really unique utility, and the first bond is issued, and it's got a parity clause in it that if it says if we issue another bond or any other debt against this utility, we both have equal right to repayment, and we have to maintain a certain debt coverage ratio. So if you're meeting that debt service coverage ratio with bond A, and then we go out and issue bond B, no year does debt service coverage go below that, so we have to take A, B, combine them together, both principal and interest, and find the maximum debt service for any given year on both bonds. And if we use that as our debt service, and then compare that to the operating, the annual operating income of the utility fund. And if we don't meet that criteria, then technically we can't issue the bond. And I have seen that happen. We had one recently, and they didn't meet the criteria, and they had to have rate increases, and then hire an engineer to ultimately project what the revenues would have been if those rates were in place, and then they did. Not only to satisfy our lenders and that, we're pushing up close to that position and not meeting the inflation is a real thing, costs are up, and that is pressure on the debt service coverage ratio. So want to just make sure we're paying attention to that, and also the parity bonds, the parity clauses in them typically express easy funds, and the easy funds are a little bit broader than just requirements for the debt, renewal and capacity funds. A lot of these funds get opened automatically when you issue a bond, as an advisor. They open these funds and they tested. Think about it again, they get closed, they're not used, cost of money to have them. But when you go to issue the parity bond, you have to have these kind of closed. So I had recently, little within the last month, move money to fund those accounts to be in compliance, and parity to issue the bond. That's good there, and then the next slide. Okay, so this one is fun. Cybersecurity. I threw this in here, like what does cybersecurity have to do with debt? Probably never thought about cybersecurity and debt. But cybersecurity is a real thing. No one is too big or too small. We see it a lot. There's hackers everywhere, and their entire job in life is trying to steal money from governments or individuals. We may be a small government, but debt, especially bonds, are big government, issue debt. You might be a big government to a hacker from a dollar standpoint, and this did happen recently. Like Township in Michigan, they were issuing a $30 million bond. Hackers gained access to email and the investment banking that wire the bond proceeds to the hacker's bank account. That is really scary. They issued the bonds, they owed the money. I do think they recovered most of the money. I haven't seen the exact numbers, but they recovered a lot of the money. But a scary time. There's $30 million going missing. Someone because delays in the process before when they lose that. So I just want to remind everybody that cybersecurity is relevant even in the debt environment. Most of these ransomware attacks, they come from someone in our organization putting on our needs. So we want to make sure we're continuing to train our employees, give it all the contingency tools. So 401k self-insurance, and cybersecurity, and it's a big deal. And this is one instance where it really impacted them, the government. And this is our last slide coming up. It's just kind of a catch-all. It just kind of spins on the plan. We never issued debt. After we issued debt, what's going to change? You issued debt, you never had any, you may need to create some funds. That's a good fund for some things. Military, bond. If you're building a massive capital project, it might be a good idea. Project fund, construction. They have a blended component that I can find right now. They have a super component. Never had any issues that the component that doesn't have to pay for that. The presentation of that component is going to have to change from the super Virginia blended. It's going to become a major fund. And they're going to have financial statements that can change for that client just due to that one debt arrangement. You may have a new bank account. A lot of those get open automatically when you issue some bonds, and there's CD fund requirements in most bond agreements. You know, you need to access the interest monthly. I don't know that everyone moves it monthly. You should, but certainly at your year end, are established, their balances, and certainly we're going to issue another bond against the same utility or carrier, so we absolutely have to do the right amount of you will not do the bond. We talked about rate covenants, debt service coverage. We want to stay abreast of those and make sure we're not pushing up too closely on those, and if we are, we're going to review our rates or our expenditures. We're going to have to do disclosures, continued reporting, bond and financial statements, bond never issued debt. That is really it. We've got one poll question and about 3.25 minutes left. The questions, you and I are happy to answer them. Chris, do you have anything to add? Or anything you want to add? We got a few minutes here. But otherwise, we really appreciate you giving Leanne and I the opportunity, and appreciate everybody hanging in with us here for almost 3 hours. I think that's all we have, Chris.
Recording stopped.
Sounds good. I know there were a couple questions that popped up, and Leanne answered them in writing, so we won't rehash those. People can go back and look at them. But thank you very much. We've got a few more seconds. I'm gonna leave this poll open, but we're certainly, once you've answered that poll, if you want to log on, feel free to do so. But I will leave it open for a little while longer. Thank you both. I know it took a lot of effort to build material for a session this long. I hope nobody ever takes that for granted, but I know I certainly do not. Effort goes into presenting it, effort goes into creating it, and I had someone tell me once, and I know it's kind of common knowledge, but you listen, you do, but to really understand the material, once you teach it, then you know. So listening to the both of you and your experience on this topic, it's pretty impressive the things that you've seen and done. So thank you for sharing your insights. Thank you for sharing your knowledge. But with that, we'll call it a day. And like I say, I'll leave the poll up for a little bit longer as we close down with a song. But certainly feel free to sign off once you have seen and done all you need to do with that poll question. Everybody else, I'll see you tomorrow morning at 8 o'clock, and we'll get started with our final day of the conference. So have a good one.
All